How do you use the risk to reward ratio the correct way in trading? Hey, it's Linus here. In this video, I'll not only be sharing with you why it is crucial for you to use the risk to reward ratio in the stock market, but I'll also be sharing with you the biggest mistake that most traders make when it comes to using the risk to reward ratio. For all of you guys who are new to this channel, my name is Linus, and in this channel, I share all things related to the stock market, so investing and trading. So if you are interested in all of that, make sure you subscribe to my channel because each week I release new videos about investing, trading, and the stock market. One of the biggest mistakes that most people make in the stock market is that they focus only on the returns. But returns alone don't tell the whole story, and here's the problem with focusing only on returns. By focusing only on returns, we're ignoring the risk that comes along with these returns. I'm sure you've seen examples of people making huge returns in the stock market on social media. But the problem with that is that many of them are taking on huge amount of risk just to make those kind of returns. So for many of them, the end justifies the means. They are willing to take huge amount of risk just to make those kind of returns. But if you are planning to continue to invest and trade in the stock market for the future, this way of investing and trading is not sustainable. Because one day the risk will definitely catch up with the returns. It's not a matter of if, but when. And when that day comes, many of them will lose huge amounts of money and might even lose more than what they earn. And that is why the end doesn't justify the means in this case for the stock market. So let me give you an example to better illustrate this point. If you can successfully rob a bank, robbing a bank is one of the quickest way to earn money. So the payoff for robbing a bank successfully is very high. So will you rob a bank? No, because you're not only thinking about the payoff, you're also thinking about the risk involved with robbing a bank. You know that even though the payoff is high, the risk involved is also very high. In fact, more times than not, most people get caught while trying to rob a bank. And when they get caught, the punishment is very severe. And that's why we won't rob the bank, because we not only take into account the returns, but we also take into account the risk. And the risk involved in this case is not worth the returns, no matter how high the returns may be. Even though this example might be a bit extreme, this is kind of like the stock market. In the stock market, you focus only on the returns. It's kind of similar like you making the decision to rob the bank just because the payoff is good. And we know that that's not the correct way to make a decision. When we are making a decision, we not only have to weigh the returns, but also to weigh the risk that comes along with those returns. The reason why we also have to pay attention to risk in the stock market is because in the stock market, we won't be right all the time. Even the best traders in the world are not right all the time. They have also their fair share of losing trades in the stock market. In fact, for many of these best traders in the world, their winning percentage in the stock market is anywhere between 60 to 70%. So they have also their fair share of losing trades. And that is why we have to pay attention to risk on top of just returns in the stock market. Because if we don't pay attention to our risk and only focus on the returns, on the times that we are wrong, we might lose a significant portion of our money or even all of our money if we are not too careful. In fact, by using the risk to reward ratio in our trading, we are building in failure to our trading. What this means is that we can still be profitable in the stock market even if some of our trades don't work out. So now that we know the importance of the risk to reward ratio in trading, let's take a look at what the risk to reward ratio is. So the risk to reward ratio measures how much we are risking to generate a certain amount of returns in the stock market. So for example, a risk to reward ratio of 1:2 indicates to us that for every $1 that we are risking, we are potentially making $2. And if you think about this, this means that we can be wrong twice and right just once to be break even. Right? Because when we are right, we are making $2. And when we are wrong, we are losing only $1. So we can be right one time and wrong 2 times and we'll still be break even. And that also means that we can be right just 1 out of 3 times and still be break even. So that's a win rate of 33.33% and still breaking even. And let's say we increase our risk to reward ratio from 1:2 to 1:3. And what this now means is that for every $1 that we are potentially risking, we are potentially able to make $3. So if we are able to do that, we can be wrong twice and right just 1 time and still be profitable in the stock market. And again, if we think about it, when we are right once, we are making $3. And when we are wrong twice, we are only losing $2 because 2 multiplied by $1. So we are only losing $2. Which means that with a win rate of just 33.33% or just right once out of every 3 times, we can still be profitable in the stock market. Do you now see why understanding the risk to reward ratio and using it correctly can be a game changer for our trading? So like I mentioned earlier, using the risk to reward ratio in our trading allows us to build in failure to our own trading and also allowing us to remain profitable even if some of our trades don't work out and are wrong. So how do we calculate the risk to reward ratio? We take the total returns on our winning trades divide by the total losses on our losing trades. And then we arrive to our risk to reward ratio. But here's where most traders get it wrong when it comes to using risk to reward ratio in the stock market. So what they do is they set their risk based on a theoretical amount. So for example, a general rule of thumb is setting our stop less than 10% away from our entry price. While the advice of not risking more than 10% of our capital on any one trade is good advice, it misses out on one important thing. So if we take a look at this example over here, let's say they set their risk to 5%. So 5% is within the 10% advice. And that's a good amount of risk that you should take in the stock market. But however, if your average gain is also 5%, then setting your risk to also 5% is not a good thing. Why? Because this then means that for every dollar that you're risking, you're only making $1 back, right? Because you're risking 5% to make 5%. So you're risking $1 to make just $1. So even if you're right 50% of the time or 1 out of every 2 times, you only break even from there. But as we have seen just now, if we want to be profitable, we want to build in as much failure into our trading as possible. And the way to do that is by increasing our risk to reward ratio. And that is why if we set our risk only based on a theoretical amount and not based on our actual results in our trading, we may end up with a poor risk to reward ratio and thus it will affect our profitability in the stock market. And that is something we want to avoid. So how do we then go about using the risk to reward ratio the correct way in our trading? To use the risk to reward ratio correctly, we want to use the actual results from our trading and not base it on just a theoretical amount. So what we want to do is set our risk based on our actual average gains. So yes, we still want to follow the general rule of thumb, which is to keep our risk below 10%. But we also have to take into account our actual trading results and our average gain. So let me give you an example to illustrate this point. If your average gains in the stock market is 8%, how much then should you control and limit your risk to? It should definitely be below 10%, right? However, we do not want to set our risk at 8%. Why? Because if we set our risk to 8%, our average risk is equivalent to our average gains, and that will not give us a good risk to reward ratio. So if our average gains is 8% and we want to achieve a risk to reward ratio of 1:2, we need to set our average loss to 4%. So this 4% is still below the 10% general rule of thumb, and it is also a small enough amount to give us a good risk to reward ratio of 1:2. And this is the correct way of using risk to reward ratio in your trading. What most traders do is they set their risk based on a theoretical amount. So like I mentioned, the theoretical amount is to be generally below 10%. So many of these traders believe that as long as they set their risk below 10%, they are good to go. However, if they don't take into account their average gains, they might have a poor risk to reward ratio, and that is why many of them are not profitable in the stock market. If you want to learn more about trading in the stock market and want more personalized coaching sessions, you can reach out to me on my Facebook or my Instagram. I've included the links down below in the comments below. In the personalized coaching sessions, I'll share with you what to buy, when to sell, how much to buy, how to minimize your risk and maximize your returns in the stock market, among many others. So if you are interested in the personalized coaching sessions, you can reach out to me on Facebook and Instagram. Hopefully you have enjoyed and learned something from this video. If you did, smash the like button because it will really help the channel grow and allow me to produce more content such as this. I'll see you in those other videos. To your financial success.